While most of the world is asleep, the global financial system may be standing on the edge of a moment that history will later name, analyze, and warn about. If you think the last Black Monday was chaotic, that silver surge, the trading halts, the sudden rule changes, then you haven't seen the real event yet. That was not the collapse, it was the tremor. What's coming now looks far more dangerous because nothing was actually fixed. The leverage wasn't flushed out, the shorts weren't covered, and the physical shortage of silver didn't improve. It got worse. Tonight, as Asian markets prepare to open for the first full trading week of 2026, we may be watching the moment where price finally disconnects from control. Over the weekend, while Western markets were closed and headlines went quiet, silver didn't stop trading. In Dubai and Singapore, in private and gray markets, transactions continued, and reports suggest those deals are already clearing far above official prices. That creates enormous pressure, like a compressed spring, waiting to be released the second official markets reopen. This is why timing matters. Markets don't reprice slowly when reality catches up. They reprice violently. Algorithms don't negotiate, margin calls don't wait, and liquidity doesn't magically appear when sellers are gone. We are entering a week where the paper market and the physical market may be forced to reconcile, and history shows that when that happens, price doesn't move in steps, it gaps. This video is not about fear or hype, it's about understanding why systems break the way they do. We're going to connect the leverage still trapped inside the banking system, the worsening physical silver shortage, the growing power of Asian exchanges, and why major bullion banks now face a problem they can't print their way out of. If the psychological $100 level breaks, it won't just be another commodity headline. It will be a signal that trust itself is cracking. And the most dangerous part of moments like these is not the volatility you see on the screen, but the confidence that disappears before anyone has time to react. What most people misunderstood about the last Black Monday is that it didn't resolve anything. Markets didn't reset, leverage wasn't purged, and risk wasn't removed from the system. What actually happened was delay. When silver exploded upward and trading was halted, it created the illusion of control, but behind the scenes, the same positions remained open. Banks that should have covered their shorts didn't. Instead, they doubled down, relying on regulatory pauses, margin changes, and thin liquidity to buy time. History shows that financial crises rarely arrive as single events. They arrive in waves. The first wave shocks participants. The second wave exposes who failed to adapt. Right now, the global system is entering that second phase. The physical silver shortage has worsened, not improved. Industrial demand didn't slow, while investment demand quietly increased. Meanwhile, trust in paper contracts eroded as traders realized that price no longer guaranteed delivery. This is why the coming move matters more than the last one. The system is now more leveraged, more fragile, and more exposed to a sudden repricing. When markets reopen after a period of suppressed trading, price doesn't gradually adjust, it jumps. That's what a gap-up event represents, reality catching up all at once. The danger isn't volatility, it's that there may be no sellers left when buying is forced. Silver is not just another speculative asset. It is a critical industrial metal with no scalable substitute. Every AI data center, electric vehicle, solar panel, and advanced circuit relies on silver's unmatched conductivity. Over the last decade, demand quietly shifted from jewelry and coins to infrastructure and technology, locking silver into long-term consumption. Unlike paper contracts, physical silver is finite and slow to replace. Mines take years to develop, and recycling cannot fill the gap. That's why physical inventories matter more than futures charts. Across Western exchanges, visible stockpiles have been draining, while delivery times stretch and lease rates rise. These are stress signals, not noise. At the same time, Asian markets treat silver differently. In Shanghai, physical settlement is central, not optional. When premiums in the East rise far above Western spot prices, it creates an arbitrage that pulls metal out of New York and London. Ounces don't flow where prices are lowest. They flow where delivery is guaranteed. This shift is subtle but powerful. It means price discovery is slowly migrating away from paper-heavy markets toward physical-first exchanges. Once that transition accelerates, Western spot prices are forced to reprice violently to compete. That's how squeezes actually happen. Not through hype, but through logistics. Bullion banks built their silver strategy on one assumption: that physical demand could always be delayed, rolled, or settled in cash. That assumption is now breaking. Like when banks sell silver they don't possess, they rely on confidence and time. But time disappears when delivery is demanded simultaneously. At higher prices, short positions don't become manageable. They become existential. Losses grow faster than balance sheets can absorb. This is why leverage is so dangerous in commodity markets. Unlike stocks, commodities can't be printed. At extreme levels, rising prices don't attract sellers. They scare them away. That's when liquidity vanishes. If silver approaches or breaks psychological levels like $100, it stops being a trade and becomes a solvency issue. Margin calls force buying, which pushes prices higher, triggering more margin calls. This feedback loop is how markets break. Banks can attempt suppression tactics, spoofing media narratives, rule changes, but each intervention reduces trust further. And once counterparties stop believing in fair settlement, paper contracts lose authority. The system doesn't collapse because of one bad trade. It collapses because confidence evaporates faster than regulators can respond. The most important signal isn't KTS coming from New York or London. It's USIS coming from the East. Asian exchanges prioritize physical settlement. Governments there openly treat metals as strategic assets. When Shanghai premiums expand and remain elevated, it signals real demand, not speculation. This creates a one-way pull on global supply. Silver mined in Mexico, Peru, or Australia doesn't care about futures charts. It follows the highest certainty of payment and delivery. Over time, this drains Western inventories and exposes how little metal actually backs paper claims. This is not accidental. In a fragmented geopolitical world, control over critical resources equals leverage. Silver sits at the intersection of energy, defense, and technology. Weaponizing that supply doesn't require confrontation, it requires patience. As more metal bypasses Western markets, price stability becomes impossible. The West is discovering what happens when financial dominance collides with physical scarcity. This isn't T about one country winning, it is S about a system built on paper encountering a world that demands substance. Silver is no longer just cheap gold. It is a strategic material embedded in the future of energy, computing, and national security. The era of surplus silver and endless paper confidence is ending. Whether the next repricing happens overnight or over weeks, the direction is already decided by physics, not opinions. When physical reality overrides financial narratives, markets don't warn, they move. By the time silver's importance becomes obvious to everyone, affordability will already be gone. History doesn't announce turning points in advance. It only explains them afterward.